Hello and welcome to the Market Now. I'm Toni Turner and it's Good Friday, April 14th. And as you know, the market is closed today for the holiday weekend. Before we go on, please know that all of us at ToniTurner.com wish you and your families a very happy Passover and or Easter. And now on to the market. Even though the market was closed today, the Commerce Department reported that U.S. retail sales fell for a second straight month in March, and consumer prices dropped for the first time in just over a year, supporting views that the economy lost significant momentum in the first quarter. But with the Labor Department near full employment, the decline in sales and consumer prices reported by the government today is likely temporary and may not change expectations that the Federal Reserve will raise interest rates again in June. So on that note, let's move on to three charts that could give us some insight into the week to come. Now, first of all, we're going to look at a daily chart as we usually do of the S&P 500 spider, symbol SPY. As you all know, this is the tracking stock or the ETF that closely follows our S&P 500 index, our benchmark index. As we're looking at this chart today, as I captured it, and again, the market is closed today. The SPY was its closing price, I should say, on Thursday evening was $232.51, which is about $23.25 on the S&P 500 index itself. Now, of course, we do remember that the SPY made an all-time high on March 1st of $240.32. It did gradually fall throughout March down to this low on March 27th. It fell to a low of, it opened down actually, it gapped down that morning, fell to a low of $231.61, then rallied back above the green line, the 50-day moving average, into kind of a little triangle here just below the 20-day moving average. These are both simple moving averages. And then in the last couple of days, the red line, the 20-day moving average, came down, and as of yesterday, Thursday's close, was coming down over to cross below the rising 50-day moving average. That's a very slight negative, but a little negative nonetheless. Again, the SPY closed down yesterday on fairly decent volume, closed at its lows. That's unusual for a holiday. Our market usually likes to rally. Before a holiday, so this is kind of unusual. But the market drifted lower on news yesterday afternoon, that the U.S. dropped a non-nuclear bomb on an ISIS compound in Afghanistan, and that's when our index started lower. Again, it's below now the 50-day moving average. We generally don't like to see that in the market, but we're certainly seeing it right now. Of course, there's been a lot of talk this week from let's call it nabobs from the big brokerage houses, saying that the market is indeed a little overbought here, perhaps a little overvalued, and it really is time for this bull market to give up some gains and take a little rest here. We do see here that there is support then. Let's call support at 230 to make it easy down here. We have support at about 232. We have more support here that goes back to January. You can see this little bump up here, and that is about at 230 or 2300 on the S&P 500 itself. We have decidedly more potential price support here down at the $225 line on the spider, or to 2250 on the S&P 500 itself. I am maintaining a cautious approach right now. I've been talking about getting more cautious in the last 3 weeks, and of course that has that caution has gradually grown, and now it's definitely, except for defensive strategies, which we'll talk about in a few minutes, I am going to put off acquiring new long positions in the coming week until the market, unless the market cheers up. Now, perhaps earnings season will help the market ramp up this week. Maybe we stay in a range here between, say, 231 or so and this high at 240. That could very well be. Or maybe the market comes down to 230 or 2300 and starts up, and then maybe we stay in a range throughout earnings season. But I want to be convinced that the market has a positive outlook before I take up or back up the truck here to add a lot of new long positions. So let's just see how this works out in the coming week and where the SPY can hold support here. Our next chart is a chart of the iShares Russell 2000 ETF. Of course, we've been looking at this as I've been getting a little worried about the market. We've been looking at this now for the past, I guess, about 4 weeks. The iShares Russell 2000 ETF is the fund that follows the Russell 2000 Small Cap Index, which, as I've told you before, is capable of kind of acting as a market leader, a market indicator, kind of telling us where the broad market might go. Now, when I captured this chart Thursday after the close, the IWM was trading at $133.72. It made an all-time high here on March 1st of $140.36. Since then, it has been really making a little short-term series here of lower highs, which we always want to watch. It did make a low here on March 27th, just like the S&P did, $132.40, bounced right back up, managed to get itself back above the 50-day moving average a couple of weeks ago in mid-March, and since then has gradually slid south again. So now, again, it closed at 133.72, just above this support line here at about 132.40, 132.50. We are going to have to see here if the IWM can hold this support line in the coming 3 weeks, that is about earnings season. About the major bulk of earnings season is about the next 3 weeks. And if we have good earnings, many stocks may rise and then pull these indexes higher, but that's something we're going to have to see. Now, interestingly enough, I did a calculation here. You can see the support line I've drawn here. There's pretty strong key support here. We're going to call it 133. And as we know, these highs up here at 140. If the IWM did have a 10% correction from its recent all-time highs, we would measure from the high up here down to the support line. And then what we call a measured move is what an expectation is if price breaks support. Say the IWM broke support at 133, 132.50 and broke below this line, then analysts look for what we call a measured move. And a measured move would take the IWM down to not all in one day or all in 1 week, but gradually it could be expected to move down to the $126 line. Now, it is just it is coincidence that the 126 line happens to correspond with September highs here back in 2016. So that's kind of interesting that it would do so. So the measured move here, or 10% down, would go to 126, and the measured move would also take us to 126. So that's an important line now I'm going to watch. Should the IWM fall below this 132.50 line, we'll call it, should it move below that, 133, 132.50, then we can potentially look for a move down to this line. So it's just something to think about. It actually would be a good thing, because then if the market does tend to move down a little bit in the coming month, actually it would give us more opportunities to get into. So I know it's a thought that makes some people nervous, but actually it's a good thing, and in order for markets to move up, they do need to move lower first, and we're a little bit overdue here. Okay, now let's go on to our final chart for the day. Let's talk about what to do if the market does get a little more cranky here. So now, as you know, when the going gets tough, when the market gets cranky, a lot of people turn to the Select Sector SPDR Utilities ETF. We've looked at this at various times over the last years. The symbol for it is the XLU. Now the XLU has 30 holdings, and its exposure to companies from the electric utility, gas utility, multi-utility, and independent power producer and energy trader companies. It has components in it like NextEra Energy, Duke Energy, Southern Company, Dominion Resources, PG&E, and so forth. Now utilities are kind of a go-to safety space when the market gets cranky, as they are a bond-like sector. Utilities typically pay very, very nice dividends. The XLU, you can't see it on this screen, it made an all-time high at $53.02 on July 6, 2016. Then it fell to a relative low that you can see on your chart down here at $45.33 in November. Since then, it has gradually climbed higher into the end of 2016, consolidated into 2017, and then moved higher, as we see, starting the end of February here. Finally, right now, as we captured this chart, it was trading at $51.68. That's where it closed on Thursday evening. Now, I am going to continue to watch the XLU, as it was one of, I've been through a lot of sectors, many sectors this morning, looking at something that I could share with you, and one of the only positive sectors that I found was the XLU, the utilities. Again, as this is where people go, this is where investors go when they want a safe space to kind of hide out in, again, in case the market gets cranky. Now I'm going to watch the XLU. Here's the rising 50-day moving average. It closed above the 20-day moving average on Thursday, and of course the 200-day moving average is down here below. So this is all good placement right now. I'm going to keep an eye on the XLU, and in the coming week, if the market just dawdles around looking a little bit unhappy, this may be a place we want to look at. Potentially, the RSI here is neutral, the MACD is neutral and trading positively, so far at least, above its zero line. Now the XLU has been consolidating for some time here, at least through March, between $51 and $52 and about 20 cents. So it's been consolidating in this range. I suspect we're going to see it here either break to the upside, or conversely, it could fall to the downside. If it remains above the 50-day moving average, stays in this space, and then starts to rally, I may nibble a little bit on the XLU in the coming week. However, if the market heads decidedly lower for any reason, please know that experience has taught me utilities will also head lower as well. Now, if the market does go decidedly lower in the coming weeks, in Tony's Market Club 3 weeks ago, we talked about how you can stay in the market when the market gets really cranky. And some of the ways you can do that are to look at gold stocks, you can look at bonds like the TLT, or you can even go to the Japanese yen, and the symbol for Japanese yen ETF is the FXY. These are all called safe havens if the market decides to get ornery here, or if it decides to head down and rest a little bit. Or if you prefer, if the market heads lower, just head to the sidelines yourself and stay there until new opportunities on the long side appear. Now, if you would like to see my comments on the market next week, Please know I am on Twitter at Toni Turner Trade. And now on to next week's economic reports. But first, please join us this coming Monday, April 10th, for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may be ripe for high potential trades. And we will talk about how to manage this getting more volatile market. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, no problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information or to join, go to tonismarketclub.com. And now for the economic reports. On Monday, we have the Empire Manufacturing Index. Tuesday, we have building permits and housing starts. Wednesday, we have crude inventories and the Fed's Beige Book. Thursday, we have jobless claims, the Philly Fed, and natural gas inventories. And on Friday, we will have existing home sales. And of course, again, we will be diving headfirst into the thick of market, the first quarter earnings season. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.